Welcome to another infographic instant with Brian Michael. In this episode, we're going to be asking which countries offer shadow bankers more desperate clients. Now, in fact, this title is a little bit disingenuous because it doesn't necessarily mean that when a company has more payable stress, they are more likely for lending, which is basically what this infographic is about. There's a number of reasons why companies can require short-term credit as part of their financing operations. However, the general motto of this infographic is that as companies rely more on accounts payable and short-term working capital, particularly working credit, that means that they're in a more vulnerable situation in terms of their capital structure. So, in fact, a better title for this infographic might indeed be, does firm asset sizes help insulate firms from payment shocks? But in any case, you get the idea. We're trying to use data in order to decide where the juiciest shadow banking clients are. And in general, we see two different groups of countries. We've plotted 4 countries as an illustration from our broader data set of the emerging dozen, which you can find in our paper. And on the y-axis, we show payable stress, which is basically accounts payable to total liabilities, and that measures the extent to which firms rely on basically trade credit, a short-term credit, particularly to suppliers, as opposed to other types of liabilities, long-term debt, etc. And on the x-axis, we plot the value of company assets in US dollars in order to make asset sizes comparable, of course. So what this infographic is trying to look at, it's trying to see if there is a relationship between countries as to firm size. When firms get bigger, do they rely more on short-term accounts payable financing, or do they rely less on it? And of course, like in the other infographics we've seen in this series, it's a mixed picture. We have some countries such as China and India who rely less on accounts payable as asset sizes of the company gets bigger. And that's actually what you would expect from organizational theory and just from common sense, that as companies become richer, as they have more assets, they tend to rely much less on short-term finance, on accounts payable, as a way of bridging their expenses. However, there's another group of countries which show the opposite trend, and we're talking specifically about Indonesia and Turkey. So for shadow bankers, these countries might represent juicy potential shadow banking clients. In these countries, the general trend is that as the value of assets gets bigger, the companies in our data set at least tend to rely more on accounts payable relative to total liabilities. So what that suggests, and again we're making a leap, an inferential leap, but nevertheless this suggests that these larger asset company sizes will need more credit, they'll need access to more funds in order to overcome this reliance on accounts payable. And of course there's several other ways of financing accounts payable rather than just relying strictly on terms given to workers, to people providing inputs and so forth. But that's a topic for another infographic. The main message of this infographic, however, is that there are countries like Indonesia and Turkey which provide potentially juicy customers for aspiring shadow bankers who want to extend credit so that these companies rely less on their accounts payable to the extent that these firms actually do want to rely less on their accounts payable. This has been another infographic instant with Brian Michael.